Welcome back in YouTube. Today we're going to go over NIO, as I did a recent video on it a few months ago. If I'm putting a 10 times multiplier EV to EBITDA on a company like NIO, I can see paying roughly $13 per share for the company. Now personally guys, I would probably be looking between 11 and 12 as it did hit this price point before, and that's about where I think technically the stock is heading from a technical perspective. Before the earnings came out, and now with earnings out, we're going to dive back in and see if we have to readjust some numbers here. So let's get into it. Now, before we update the quarterly reports into our model here, I want you guys to understand when I made a video on NIO, it didn't get a lot of appreciation as I was well under what the trading price was and what expectations of investors were, meaning that there is this cult following with a lot of companies. And when you're not giving positive information, even though it might be right, people tend to dislike the video and or make mean comments. So guys, I just ask you to be open-minded, as my price target was roughly $11 months ago when the stock was trading over 20, and now that the stock is completely selling off due to some of the things that I mentioned in the video, we have to reevaluate the price, and it's probably not going to look as good as it was at 11. So I'm just giving you guys a fair warning. So if you're a bias on NIO, if you're a biased NIO investor, you might not want to watch this video. So on the first line here, I'm starting to notice that there were 25,000 deliveries, and a year ago that is up 14.4%. Now, the big thing I'm already going to start noticing is that our growth rates in our model were much higher than 14 and 20%. We had over 50% projected growth rates because that is what the experts were telling us to use. And guys, when I always told you this, when you're doing these models, please undershoot what the experts are saying. A lot of these guys, a lot of these experts are already invested in the company. They're very emotional about it, and they push numbers very high, and they're not thinking about the economic backdrop. So when you're running your valuations, always be conservative. The only person it's going to help when you're being conservative with numbers is your investments. We can see here they did a little over 1.4 billion in US dollars, representing an increase of 21% from the second quarter of 2021. So they're growing roughly 21% year over year in this quarter. But the problem is when we ran our analysis, we were using 60% growth rates here, as we can see in the top left-hand corner, 60% growth rates for the first 3 years, and then going down from 25 to 15. And what do we have? We have a $9 discounted cash flow calculation with a $16.67 EBITDA calculation, which equated to roughly $11 to $12 price target that we had months ago. Mind you, once again, this is when the stock was pushing over $20, and a lot of people were not happy with this video. Where is the stock trading today? It is roughly down $8.48, down 24% on the day. And one of the things we've mentioned in the video is going to be a few different things. Number one is going to be dilution, okay? We have to be concerned with dilution. We also have concerns of their accounting, right? Anytime we're dealing with foreign companies, guys, their accounting could be completely different from the accounting that we do here and the standards of accounting that we use in the United States. So there is a lot of risk with investing in foreign companies from an accounting perspective. How transparent are they really being? And then you have to factor in political concerns as well. Therefore, when you're running analysis on foreign companies, you have to use a lot of different types of buffers. One buffer I would recommend is using a lower multiple on EV to EBITDA. The second one I would recommend using is, instead of looking for a 10 to 12% return, put a 15 to 18% return in there. That way you're building some safety within your investment. We also see margin compression here, which is one of the things I mentioned with inflation in my last video. So margin compression is another thing we have to talk about. So not only are they not firing on all cylinders, as a lot of analysts were expecting us to kind of put in our models, but on top of that, they're starting to deal with inflation, and that is squeezing margins. When we equate all this up, it comes out to a gross profit of 200 million, which is a decrease of 14.8% from the second quarter of 2021 and a decrease of 7.4% from the first quarter of 2022. Gross profits are going the wrong way, guys. These are things that we brought up in the last video. I had concerns with political tension. I had concerns with inflation. I had concerns with the fact that they might not be selling as many cars due to the fact that we're heading into a possible global recession and the competition is picking up. Net loss was $411 million in the second quarter of 2022, representing an increase of 369%. So net losses are skyrocketing on the company as well. Cash and cash equivalents are now sitting at $8.1 billion. So we will up the cash on hand as they look like they have more cash on hand. So we updated the 8.1 billion cash on hand. And here's where it gets a little concerning owning the company just by looking at a share earnings per share, guys, going from negative 42 cents down to 112 and up to 168. Earnings per share is going in the wrong direction here. And, you know, when you want to break things down to the simplest form, just look at what are you getting as a shareholder. And right now, every share you own, you're losing $1.68. We can see here that shares outstanding should be 1.632 billion. Call 1.633 just to keep it easy. So we can see that they've added more shares, so we have to equate for that as well. And it was 1.633 billion shares outstanding. What we're seeing here is growth rates are impacted, margins are impacted, but yet they have high hopes for the second half of 2022 with the delivery of new products. Now, the only thing I'm curious in at this point in time is finding a full year guidance of 2022 so I can match it up with my model here. As we can see here, when we look at the 6 months ended in June, they're doing $3 billion. So which means that I could probably use about $6 billion to safely assess the company as, you know, they think they're going to do better in the second half. So let's see what that looks like. As you guys can see here, I have them doing closer to 8 billion off of the growth rates that we projected. So what we have to do is lower these growth rates to where it gets a little bit above 6 billion. So this now changes the model pretty drastically here, guys, as 27% growth rate would put this over 6 billion, just below 7 billion. And then that would leave to 8.7 in 2023. 11.11 billion in 2024, and I'm keeping a fairly high growth rate for the next 6 years. Reason being, I'm going to keep these growth rates fairly high and say that they might do a little bit better over the next 3 to 6 years, is the fact that right now we're in uncertain times, and I think over the next 3 years we could get out of this. The economy could be doing better. China's going to reopen up, and there's going to be that opportunity to possibly outgrow what they've done over the last 3 years. So now this is complete speculation on my point, but what I want to show you guys is when we re-update all the calculations in this model, we can see here that we have to adjust for about a $9 price target. Now, with a discounted cash flow analysis, it's sitting right around $4.50. So I'm going to give you guys a couple price targets here because we're only using a 10 EV to EBITDA multiplier. So if we go 4.61 plus 9.22 equals 13 divided by 2 equals. So I get a $6.91 price target averaging these two numbers here. Now what I'm going to do is use a 12-time multiplier because I could see them trading for a little bit more of a premium. This is the safety that, guys, this is the safety that I've talked about building in for myself. We use a 10 times multiplier, and now we're looking at 1071 plus 4.61 divided by 2. We get a $7.66 price target. So just updating the quarterly report, guys, this is why it is so important not to just go off of what analysts are saying, because the analysts are saying 40 and 50% growth rates, when now we probably have to be looking at a 3 to 4 year span of 28 to 29% growth rates, which is literally cutting the price in half. And that is a big reason, on top of obviously political tension, that is a big reason why we're seeing today's move in NIO. So I wanted to shed some light on there for you guys. As always, I appreciate your time. So for me to even get interested in the stock, this is where I would be looking to buy. Now, if I'm already purchased in the stock and I want to add more, the price targets that I'm giving out would be personally what I would do, guys. This is not financial advice, but if I've already started dollar cost into averaging into this position because I find it interesting, the next time I would be buying would most likely be those price targets that I set out. So if this breaks below $7 or if this breaks below $8, I'd probably be looking to add some more if I was very bullish on this company. So that's basically wanted to re-dive into kind of my analysis on NIO. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.